The market is open and we see pretty much green right across the board. However, our focus is on Celsius Holdings, which trades at $30 and is at its 52-week low. Is this a trap or is this a golden opportunity for us to buy a very good growth stock moving forwards? Now, we do have a double buy rating seeking out from Wall Street, although we do have an interesting strong sell from Quant. So let's take a deeper look. Now, the first thing we want to understand, just last year, this company had around 5.9% in terms of the market share in the energy drink sector. Coming third, as we can see, we had Monster in second place and Red Bull in first. But interestingly, from that 5.9% market share, in their latest presentation, they talk about how that is pretty much doubled right now, sitting at 11.4%. So that is a good sign, a growth company that is taking its market share from its competitors like Monster, like Red Bull, as well as some others. We also note some very good signs about this company in terms of expanding globally, as we can in fact see the second half of 2024 sales have been implemented into Australia. We see New Zealand as well as France. So we do believe moving forwards there will be other areas, other countries that they will look to move into, but growth does look very strong. And when we look at it from a numerical perspective, over the last few quarters, we do see this increasing, something we do believe Celsius will continue to propel forwards as they do continue to expand. We also want to point out from their latest earnings, if we just look at it on a quarter by quarter basis, top line revenue is up 23%. In fact, the bulk of that, as we can see, is 30% from international space, with their gross margins up 320 basis points. As we always say on this channel, if we can see the efficiencies in the margin on top of the revenue growth, then you can pretty much see this could be a very good high quality company to consider. Net income also looking good, around 55%, and the earnings per share also increasing double digit 65. So very good numbers when we look at it on a quarter on quarter basis, and that is pretty much re-emphasized when we look at it from the first half year of 23 to the first half year of 24. Double-digit increases right across the board, strength in the international again, very nice growth in their margins, and we can see very high double-digit increases to their bottom line as well as the earnings per share. So it is doing all the right things, but why ultimately has this company been suffering over the last year? Now, the first thing that we want to talk about is how we do hear a lot about how this company's demand is slowing, and we have to understand that some quarters we have seen triple-digit growth. Granted, now we are seeing this come down to double digits. It is understandable why a lot of analysts are worried that the growth spurt of this company is coming to an end. And the other thing that we can discuss is their distribution agreement with PepsiCo, where there are talks now of how sales are starting to slow down and that they are looking to take on less and less inventory. If you are someone who has been purchasing their actual products from Celsius, the energy drinks, you will see that in quite a lot of stores, they are having a lot of promotions, a lot of discounts, which investors do not like to see. They believe this is showing that the demand isn't just there for where it wants to be for a company that has been growing at a very rapid rate. And as we can see, that is mentioned here, that there is that concern around the growth starting to mature in this market, and that we will see less and less increases that we like in the double-digit region moving forwards. And as we can see here, there are analysts who have been reducing essentially the target price for Celsius. In fact, the issues around the inventory management for PepsiCo has started to pull them away from the very large growth they did believe this company could produce moving forwards. And that very, very interestingly, that Red Bull are now taking away market share from Celsius with their new flavors. Now, we do also note that Celsius themselves have bringing out more flavors, and we just pointed out from 2023 to 2024, their market share has pretty much doubled. The other thing which we've already discussed here is the promotions that they continue to bring out. So you buy, whether it's one pack or two, get the third one 50% off, or whatever promotions they do put out on their products. Ultimately, if you do have a good product, you wouldn't necessarily need to continually put it on promotion, but that is something that investors are seeing with this product, so it does give a little bit cause for concern when thinking about future sales growth. Now, the other reason that gets brought up is the compelling valuation that looks to be very, very high, And that is what we're going to take a look today in detail to understand whether or not we believe actually the valuation is good to consider around the $29, $30 mark. Now, first things first, as we already said, down 45% over the last 12 months. Over the last 10 years, though, it has increased rapidly, up nearly 18,000%. That is astronomical, very, very strong. And we also note it is pretty much quite some way away from the all-time highs that we saw around the $100 mark. Now, forward P, it is around 36.4, and we can take a look to see essentially what that is moving forwards if they hit their earnings per share estimates. But first thing, when we do look at their metrics, particularly the free cash flow per share, it has been negative pretty much all the way up until 2021. Nice to report, last 2 years looking positive, as well as the expectation over the next 12 months to pretty much near enough double to 73 cents. Sales growth, we've already touched upon this. You do have to question whether or not you do believe they can continue to keep up with the historic growth they had. I mean, just the last 3 years, triple digits. Before then, very respectable double-digit growth. And on a trailing 12-month, 56% is still very strong. Remember, the question as an investor you need to ask is how much of that do you believe they can continue moving forwards? And remember, they are having a lot of international expansion, which has helped grow their revenue on that quarterly basis of around 30 to 40%. Numerically speaking, no surprise then, this company has been increasing rapidly. 10 million of sales in 2014, 1.32 billion in 2023. And we also note they have been diluting your position as a shareholder over the last 10 years fairly rapidly, but to be honest though, you would not care given how fast that share price has increased. Now, ROIC, we always want to see 10% or more. We only see that in 2023, and nice to note on a trailing 12 month at 27%, which will go to show us when we do look at that income statement, they haven't been profit making that much of the last 10 years, and that is also shown when we can look at that operating margin. In fact, we only have 2 of the last 10 years where it was positive, 20% in 2023, 6% in 2020. Remember, at the bare minimum, we do want to see 12%, although what we are liking from when we looked at the data, their margins are increasing, especially that gross margin on top of the revenue. So that is also a good thing to note. Free cash flow as well, last 2 years looking good, around 8 to 14%, minimum 5%, which we haven't seen historically that consistently, but something to bear in mind that moving forwards, we do hope to see these strong numbers. Net debt to EBITDA effectively telling us because it is 0 from 2019, it wouldn't have even taken them 1 day over the last 5 years to pay off all of their debt net of cash on hand. The same expected over the next 12 months. So balance sheet does look very good, which is always nice to see for a growth company. Now we also want to point out we have released our latest free weekly article where we do talk about what's happened in the market over the last few days. In the more recent one, we talk about 3 stocks we're looking to buy this month, but pretty much every week we do cover stocks that we do believe deserves your attention. So you can click below, sign up and read straight away. And you can also grab 36 undervalued dividend stocks that we do believe warrant your attention for the month of October. Lots of information as well as those that sit within our portfolio. And in fact, this month you can grab 2 spreadsheets. We also look at 22 dividend stocks that have the most upside according to Wall Street. So again, click below, sign up, and you can have instant access. Other parts of analysis we like to do, well, firstly, insider ownership at 2.2%. We see quite a significant number of sales over the last year, 191 million. Whilst we see no movement in quarter 4, we notice around 2.5 million sales in quarter 3 and a whopping 108 million in quarter 2. Now, when we take a look to see who these insiders are, in fact, the more recent one on the 12th of September, so just a few weeks ago, the CEO did sell around 75,000 shares, which did net him around $2.5 million. Remember, insider selling, not a bearish signal. They sell for many reasons, personal or financial. Now, the same analysis for institutional ownership, well, 61%, 608 million worth of sales over the last year, a lot more buying over the period, 3.21 billion, although in Q3 we don't really see much movement. In Q2 and Q1 and Q4, so the previous 3 quarters, we see a lot of buying. So institutions do clearly like CELH holdings. Now, in terms of their income statement, as we can see, their revenue has been growing at a very dramatic rate over the last few years. Very, very rapid. In fact, going from 15 million in 2014 to 1.3 billion in 2023. But as always, this part we want to highlight what we've already mentioned about the bottom line. Significant number of years over the last 10, they actually reported a loss. Notably though, 2023 they did turn a profit at 227 million. This is something we do want to see from Celsius moving forwards. Now their revenue has accelerated at a very rapid rate. In terms of the balance sheet, we already said it is very strong, but we will just show that here very briefly. Their total cash has gone from 0.3 all the way to around 903 million, so very, very large increases over the period. And when we compare it to their total debt numerically and directionally, we can see for Celsius, it has in fact gone down, which is great to see. Cash has gone up. Their total debt has gone from around 10.8 million in 2014 to just 1.8 in the latest report. So already stated, their balance sheet does look very good. It is one of the things we like to identify in companies that we want to purchase, having a strong balance sheet. Now, in terms of their earnings moving forwards, they anticipate 2 out of the next 4 to be positive. Notably, the next quarter, they are expecting a negative 78% year-on-year EPS decrease. Over the last 4 quarters, though, we can see 3 of them they have beat, 1 miss, 75% track record, with the more recent quarter being a beat, and they still anticipate growth of the earnings per share over the next full year, lowering down that forward P to 28.54. Now, in terms of some gradings, the first one on the valuation aspect, they do get a D-. As we can see, they do trade at a valuation of 36.4 on the PE gap forward looking, with essentially the sector much lower at 20.1, which means right now, if you purchase this company in your portfolio, you are paying an 81% premium, which is shown throughout all of the other valuation models as well. Whether or not this company deserves a premium, something to consider, something we will look at when we come to our margin of safety. In terms of growth, well, they get an A-. We can see year on year, very strong, 57%, sector median 2.44, forward looking 37.26%, and we can in fact see here a lot better than the sector of low single digit. Then when we take a look at the final profitability aspect, we can see A-, looking very strong gross profit wise, 50.5%, 36 equivalent for the sector, and the bottom line looking very healthy and strong, 20% versus the 4.35 of the sector median. Finally, we get to the cash from operations, which is lacking a bit in comparison, 271 million versus 728 million from the sector overall. Now, as we already said, a double buy rating with a strong sell from quant, D- on valuation, A- on growth, and A- on profitability. Now, last thing before we do jump into the valuation, when we do compare it to some others that are of a similar size, what we do note on a total return basis, Celsius is the only one to have returned negative, in fact negative 44%. Over the last 5 years, we can see no surprises, and over the last 10 years, it has had massive outperformance in comparison, up 17,870%. Now, obviously, do bear in mind, it doesn't mean that they are going to perform as good over the next 10 years, as past performance isn't essentially a factor in future performance. And this leads us to our intrinsic value, our valuation, which as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $52, we essentially ran it through the DCF model where we have the free cash flow year on year. Average growth rate, it is skewed. It's gone from negative to positive quite a number of years, but we've gone for 25%. Now that is a low, medium and high rate. And as we can see, with the discount rate at 8%, we then get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding. And as we can see here, 52.37 is the intrinsic value, indicating 81% upside to the current price. As always, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Celsius or any other companies you do desire. For full transparency though, we will show you at the 20% rate for those that are more conservative, an intrinsic value of $38.48, and at the 30% point we can see $71.25, which indicates more than double, 146% from the current value. As we mentioned though, 25%, we're going to take that through, and we always like to apply a margin of safety. Now we start off with 10% on this channel, execute if it meets that 3 criteria: wide moat, strong financial metrics, and good forward-looking data. Now look, if you believe that, it is a buy up to $47.14, but we keep going till it's near the current trading price. And what we can see in today's episode, at 40% a buy at $31.42, you are pretty much getting a 45% MOS if you can get this around $28.81, which really will come down to whether or not you do believe they will continue to grow at a very rapid rate. Maybe you believe that is too optimistic, maybe too conservative, but remember what assumptions we have used. So a near 45% MOS. Wall Street themselves, very bullish. They give it 76% upside at $51, so they do clearly believe that these targets are achievable. As always though, do give us your thoughts in the comments below. Is this one you are considering to add to your portfolio? 45% MOS, 76% upside. If you did enjoy the content, smash that like button, hit that subscribe and bell button, and don't forget to sign up to the free weekly newsletter and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.